I actually read Vanguard's 51-page retirement report so you don't have to, and one thing in it genuinely shocked me. I'll get to that in a moment. But first, let me tell you why you should care. Vanguard is the company that built the modern low-cost index fund industry. They are the reason you can buy a total stock market ETF for 3 basis points. They are the patron saint of the Bogleheads community, the people who believe that buying the whole market and holding it forever is the only sensible way to invest. So when Vanguard publishes a 51-page report on retirement income, you expect them to say, keep doing what you're doing, 4% rule, total market index funds, done. That is not what they said. The report is titled something incredibly boring. I am not going to read it to you because you would fall asleep. But inside, Vanguard lays out 3 main strategies for turning your nest egg into a paycheck that lasts as long as you do. They call it a smart withdrawal order, covering essential expenses with guaranteed income and dynamic spending with guardrails. Sounds like corporate jargon, I know. But beneath that language is a quiet admission that the standard retirement advice you have been fed for decades, the 4% rule, the max out your 401 can wait until 65 dogma, might not be enough. And that admission becomes interesting when you realize who is making it. If you do not know Vanguard's reputation, here's a quick summary. Jack Bogle started it in 1975 with the idea that most active managers do not beat the market, so why pay their fees? That philosophy turned into the first index mutual fund, then the first publicly available ETF, then an entire movement. The Bogleheads community, hundreds of thousands of DIY investors, treat Bogle's principles like scripture. And those principles basically say low-cost indexing, asset allocation, stay the course, and withdraw about 4% per year adjusted for inflation. That is the playbook. It has been for 30 years. So when Vanguard publishes a report that goes beyond that playbook, when they start talking about annuities and insurance products and dynamic withdrawal rates that adjust based on market returns, you have to wonder why. Are they expanding their product line? Or is the data telling them something that the simple 4% rule cannot handle? Here's what I found inside. The first strategy is about the order in which you take money out of your accounts. Most people think it does not matter, money is money, right? Vanguard ran the numbers and says it matters a lot. Pull from taxable first, then tax-deferred, then Roth last. Doing it in the wrong order can cost you 14% more in taxes over a lifetime. That is not nothing. The second strategy is where it gets weird. They say you should separate your essential expenses, housing, food, healthcare, from your discretionary spending, and then cover the essentials with income that cannot fail. Social Security is part of that. But they also say, and this is the part that genuinely surprised me, you should consider buying an income annuity to fill the gap. A product that pays you a fixed amount every month for the rest of your life. From Vanguard, the low-cost index fund people. I read that paragraph 3 times to make sure I was not imagining it. The third strategy is the one that makes the most sense to me, dynamic spending. Instead of blindly adjusting for inflation every year, you cap your raises in good years and take small cuts in bad years. It is a set of guardrails that keeps you from running out of money or from panicking during a crash. And Vanguard's own data shows it works. But for the full picture, you need to see how these 3 strategies fit together and what Vanguard quietly left out. If you are the kind of person who wants to know what the research actually says before making decisions, hit subscribe. I dig through these documents so you do not have to, and I share what matters every week. So let us walk through what Vanguard actually says, then I will tell you why it made me pause. The first strategy in Vanguard's report is about the withdrawal order. And it immediately challenges conventional thinking. Because almost everyone focuses on the amount, the 4% rule, the safe withdrawal rate. But Vanguard's data shows that where you pull the money from can actually have a bigger impact on how long your portfolio lasts. And that gap, the difference between the naive approach and the smart order, adds up to a 14% tax saving by age 100. That is a shocking number when you realize you get the same spending either way. It is not about cutting your lifestyle or taking more risk. It is about not handing extra money to the IRS every single year for decades. Here is the order they recommend. You start with your taxable accounts, brokerage accounts, savings, anything that is not tax sheltered. Next, you pull from your tax-deferred accounts, your traditional IRA or your workplace retirement plan, the money that grew without taxes but will be taxed when you take it out. Last, you touch your Roth IRA because that money comes out completely tax-free, and you want it compounding for as long as possible. Most retirees do the opposite. They grab from the easiest account first, often the checking account connected to the IRA, without thinking about the tax consequences. Or they withdraw proportionally from everything, spreading the tax burden across all accounts equally. Vanguard's data shows both approaches cost you serious money over a 30-year retirement. They ran a model comparing the smart withdrawal order against the naive proportional method. Same spending in both scenarios, same starting portfolio, same everything. The only difference was the order of withdrawals. And the result? The smart order cut cumulative lifetime taxes by about 14% by age 100. That is not a rounding error. On a mid-sized portfolio, we are talking tens of thousands of dollars that stay in your pocket rather than going to the IRS. Let me make this concrete. Imagine you are retiring with a taxable brokerage account holding $200,000, a traditional IRA with $300,000, and a Roth IRA with $100,000. Under the naive method, you might take a fixed percentage from each account every year. That means you are pulling from the Roth earlier than you need to, losing years of tax-free compounding. You are also withdrawing from the traditional IRA early, which increases your taxable income every single year, potentially pushing you into a higher bracket and causing more of your Social Security benefits to be taxed. It is a cascade of avoidable tax drag. Under Vanguard's order, you spend down the taxable account first. Those withdrawals are only taxed on the capital gains, not the entire amount. Meanwhile, your traditional IRA keeps compounding untouched, and your Roth grows tax-free for decades. By the time you exhaust the taxable account, maybe 10 or 15 years in your required minimum distributions from the traditional IRA are kicking in anyway, so you are not creating extra tax years. And the Roth stays until last, giving you a massive tax-free bucket in your late 80s and 90s when your other accounts are thinned out. The psychological trap here is that people think they are being smart by touching the Roth early because they want to avoid paying taxes now, but they are actually hurting themselves. That Roth growth over 20 years could double or triple tax-free. Draining it early is like selling your most productive rental property first because it does not have a mortgage. You save on current expenses, but lose the future income. Vanguard's model proves that delaying the Roth to the end adds years of compounding that you cannot get back. This is not theoretical. Vanguard's own modeling shows that over a 30-year retirement, the right order can extend the lifespan of your portfolio by several years purely from tax savings. You get the exact same spending power, you lose less to the government along the way. It is not sexy. It does not make for a good headline. But it can mean the difference between running out of money at 92 or at 100. If you like getting this kind of research without reading the boring documents yourself, hit subscribe. I do it for every report I find. I read the fine print so you can focus on what actually moves the needle. That is the first piece. Now, Vanguard goes deeper into how to make sure you actually spend what you can afford, and that is where the truly surprising recommendation shows up. Vanguard says you need to separate essential expenses from discretionary ones. And then they drop a recommendation that genuinely shocked me. They tell you to buy an income annuity to cover the gap. I have read enough Vanguard documents to know they do not make recommendations lightly. This is the same company that built the first index fund for individual investors, the institution the Boglehead movement treats as scripture, the firm that spent 40 years convincing you to ignore Wall Street's fees and complex products. And now, buried in page 32 of their retirement research, they are pointing you toward an insurance product that historically carries commissions, surrender charges, and opaque pricing structures. I had to read that sentence 3 times to make sure I was not hallucinating. The logic behind the recommendation makes sense on paper, and you need to understand it before you judge it. They argue that essential expenses, housing, food, healthcare, must be covered by income that shows up no matter how long you live or what the market does. Social Security is the first piece of that puzzle. But for most people, it does not cover everything. Their example: your essential expenses run $50,000 a year. Social Security covers $30,000. You have a $20,000 gap. The standard advice says pull that from your portfolio. But that introduces sequence of returns risk, the chance that a bad market early in retirement permanently damages your withdrawal math. Vanguard says instead, fill that gap with guaranteed income that does not depend on market performance. They call this the income floor, and they argue it is the single most important structural decision you make in retirement. Here is their modeled case. A 67-year-old woman with $500,000 in savings. Her target retirement income is $45,000 per year. Social Security provides $15,000. Without an annuity, she would need to withdraw $30,000 from her portfolio each year, a 6% withdrawal rate. Vanguard's data shows that over a 30-year retirement, that rate faces a significant probability of failure, especially if the first 5 years include a market downturn. If she instead allocates 60% of her savings, $300,000, to an immediate fixed annuity, she locks in a guaranteed annual payment of roughly $18,000 for life. That pushes her guaranteed base income to $33,000, covering most of her essential spending. The remaining $200,000 stays invested and she withdraws a more sustainable amount from it. Vanguard's model shows that by age 83, her total wealth, the net present value of annuity payments, plus what is left in the portfolio, is actually higher than if she had never bought the annuity. And her annual spending stays above $30,000 through age 100. The annuity provides a floor that lets the portfolio breathe, protecting it from being drained too quickly in those early retirement years when a market drop could be fatal. I cannot overstate how much that bends the standard script for the Boglehead crowd. The cognitive dissonance is real. The very institution that taught you to avoid fees and complexity is now pointing you toward an insurance product that historically carries high expenses and opaque pricing. And there are some serious problems with this recommendation that the report glosses over. But before you run out to buy one, let us look at what they did not tell you. Vanguard says you need to separate essential expenses from discretionary ones. That difference matters more than any withdrawal rate calculation, because your brain treats a dollar spent on food very differently from a dollar spent on a vacation, and your withdrawal strategy should reflect that. Essential expenses are the ones that keep your life running. Housing, food, healthcare bills that show up every month, whether the market is up 10% or down 20%. Vanguard's argument is that these need to be covered by income that shows up no matter what for as long as you live. Not by selling shares during a downturn, not by hoping your portfolio recovers in time. Income that is guaranteed. Social Security is the first piece of that puzzle. If you have $50,000 in annual essential expenses and Social Security covers $30,000, you have a $20,000 gap. That gap is the problem Vanguard is trying to solve. And here's what surprised me. Vanguard explicitly says you should consider buying an income annuity to fill that gap. Let that sit for a moment. The company that taught an entire generation to avoid high fees and complex products is telling you to consider an insurance contract. They walk through a specific example in the report. A 67-year-old woman with $500,000 in savings wants $45,000 a year in income. Social Security covers $15,000 of that. That leaves a $30,000 shortfall every year. If she tries to take 6% out of her portfolio each year, the math gets risky. Sequence of returns risk eats away at the principal, especially if the market drops early. But Vanguard models what happens if she puts 60% of that $500,000 into an immediate annuity. Under that scenario, she can maintain nearly 70% of her spending target all the way to age 100. And get this, by age 83, she is actually wealthier with the annuity than without it. The guaranteed income stream let her portfolio last longer because she stopped pulling from it as aggressively. This is the same Vanguard that built its name on low-cost indexing. And they are now saying you need an insurance product to make retirement work. I cannot overstate how much that bends the standard script for the Boglehead crowd. The cognitive dissonance is real. The very institution that taught you to avoid fees and complexity is now pointing you toward a product that comes with commissions, surrender charges, and opaque pricing. If these kinds of research deep dives help you see past the marketing, hit subscribe. I read these reports so you do not have to, and then I tell you what actually matters. So the logic makes sense in theory. Lock in a floor for essential expenses. Let the rest of your portfolio handle discretionary spending. Vanguard's own data shows it can improve outcomes for people who face the real risk outliving their money. But there is a catch, and it is the kind of catch that makes me cynical about how this recommendation gets implemented in the real world. That catch is what we need to talk about next. Before you run out to buy an annuity, let us look at what Vanguard soft-pedaled in those 51 pages. The risks they acknowledged in one sentence and then moved past. Here is the part of the report Vanguard soft-pedaled, and it is the detail that genuinely shocked me. First, inflation. Most income annuities, especially the single premium immediate annuities Vanguard uses in its models, do not come with an inflation rider. That means you lock in a fixed monthly payment today, and 30 years from now, that same dollar amount buys less than half of what it used to. Let me make that concrete for you. If you lock in $30,000 a year of annuity income today, and inflation runs at a historically average 3%, then in 20 years, that $30,000 has the purchasing power of about $16,600. By year 30, it is down to around $12,300. That is not covering essential expenses in your late 80s. The report mentions this in a single sentence, then moves on. But if your essential expenses in retirement are things like healthcare and rent, those costs tend to rise faster than general inflation. Medical inflation has historically run 1 to 2 percentage points above the headline number. So you could end up 10 or 15 years in with an annuity that covers a shrinking slice of your actual needs, and the gap widens exactly when you are most vulnerable. Second, flexibility. Once you hand over a lump sum to an insurance company for a single premium immediate annuity, that money is gone. You cannot access it for emergencies. You cannot rebalance it when the market drops. You cannot leave it to your kids. It is a permanent trade liquidity for predictability. That works fine if nothing unexpected happens. But if you get hit with a major medical bill, or your roof needs replacing, or your daughter needs help with a down payment, you have no recourse. The money is inside the insurance company's reserve pool, not in your checking account. And here is the psychological angle that the report skips entirely. Knowing you cannot adjust your income stream if something goes wrong actually makes people more anxious, not less. You trade the fear of running out of money for the fear of being trapped. Neither is a great place to be. Third, and this is the one that makes me cynical, the historical data suggests staying invested in a diversified portfolio of stocks and bonds almost always outperforms buying an annuity over a 30-year retirement window. Vanguard knows this. Their own research on dynamic withdrawal shows that a portfolio with Guardrails yields higher end-of-life wealth than an annuity for most scenarios. In fact, the same modeling Vanguard uses shows that a dynamic withdrawal strategy leaves you with roughly 40% more wealth at age 100 than the annuity path, assuming average market returns. So why are they recommending annuities at all? Because the trade-off is not about average returns. It is about the tail risk of living to 95 or 100 with no income left. Annuities are insurance against that specific outcome, not an investment. But the way the report presents it, you might walk away thinking annuities are a core building block, rather than a niche product for people with a specific risk profile and a family history of longevity. And here's the kicker. The largest annuity provider in the United States a few years ago was AIG, the same company that needed a government bailout in 2008 because its insurance obligations exceeded its reserves. The company that sells you safety had to be rescued by taxpayers. When systemic risk hits the insurance industry, the counterparty you are counting on may need a federal lifeline. That does not mean all annuities are bad, but it does mean you should understand who is on the other side of that contract and whether their promises are backed by something more than marketing and state guarantee associations with limited coverage. This is the moment where you realize the retirement industry has been selling a simplified version of math. The 4% rule was never a golden rule. It was a rough guideline based on historical data from a specific period, popularized by the Trinity study in 1998, and based on data that ended in the early 1990s. It assumes a static withdrawal rate, ignores sequence of returns risk, and treats every retirement as if the market will cooperate. And now even Vanguard, the pioneer of low-cost indexing that built a community around self-managed portfolios, is quietly walking it back by suggesting you need insurance products to cover essential expenses. That was the one thing that genuinely shocked me about reading this report. Not the annuity recommendation itself. It was the realization that the industry has been overselling simplicity for decades, and the data has always been more complicated. Here's the part that never makes it into a retirement calculator. I built a digital book called The Exit Code that takes 50 years of actual retirement data and turns it into a mathematical framework for exiting the rat race. It covers the dynamic withdrawal method that replaces the 4% trap, a rules-based system that adjusts your spending based on market performance instead of locking you into a fixed number. It includes the $14,000 invisible insurance bill that destroys retirees under 65 who lose employer coverage before Medicare kicks in. And it lays out the lazy portfolio, a low-cost, diversified mix that has historically beaten active traders over 3 decades by staying out of their own way. Every number comes from actual data, not opinion. You can get it through the link in the description for less than 1 hour with a mediocre financial advisor. Because knowing these numbers and building a system around them are two very different things, and the data is too dense to navigate alone. So once you understand the annuity catch, you are ready for Vanguard's third strategy, which actually makes more sense. If you want more research that cuts through the marketing, subscribe. It helps the algorithm show this to people who actually need it. And the piece that genuinely stopped me, the one that made me reread the page twice, is Vanguard's third strategy, dynamic spending with guardrails. This is where the report goes from academic analysis to a practical tool that actually protects you from your own worst instincts. Here is how Vanguard frames it. Instead of picking a fixed dollar amount every year and hoping it works, you set what they call guardrails. Think of them like bumpers in a bowling lane. In a good year, when your portfolio has grown, you give yourself a raise, but you cap that raise. Vanguard's data suggests capping it at something like 12% above inflation. You do not let lifestyle creep eat your gains. In a bad year, when your portfolio drops, you take a trim, but again, you cap that trim. You might cut spending by 2 or 3%, not the 20% crash you feel like you need to survive. Now let me walk you through what that actually looks like in dollars. Say you have a portfolio of $1 million and you are spending $40,000 a year. The market drops 20% in year 2. That is a $200,000 loss on paper. Without guardrails, your instinct might be to keep spending the same $40,000, pulling from a shrunken portfolio. That is exactly how sequence of returns risk eats you alive. But with guardrails, you have already decided. In years where the portfolio drops below a certain threshold, you cut spending by, say, 3%. So instead of $40,000, you spend $38,800. That feels painful in the moment, but it is nothing compared to the pain you will feel at age 92 when the cliff appears. And here is the crucial part. The retiree who uses guardrails does not end up poorer, they end up wealthier. Vanguard ran the model 2 ways. One retiree spends the same flat amount every year, adjusted only for inflation, with no adjustments for market conditions. The other uses dynamic spending with guardrails. What does the chart show? The flat spending retiree looks fine through their 60s and 70s. At age 92, the line falls off a cliff. They run out of money because they never adjusted for the bear markets in between. The dynamic spending retiree makes small, painless cuts during the bad years, small, reasonable raises during the good years. And at age 100, that retiree still has more wealth than they started with. That is the power of letting math guide you instead of fear. Now, why does this matter for you? Because you are not a robot. You will not make these decisions in the moment. Imagine watching your portfolio drop 20%, and that happens on average at least once every 6 years, by the way. If you have a 30-year retirement, you will face that drop multiple times. At 11 p.m., with the news screaming recession, are you going to calmly decide to trim your discretionary spending by 3%? No, you are going to panic. You might pull everything out, or you might cut your spending to the bone and hate every minute of it. That is the sequence of returns risk. It does not only hurt your portfolio, it hurts your behavior. The guardrails solve that because you set them ahead of time. The decision is already made. The market tells you what to do, not your amygdala. There is another layer Vanguard does not shout about. The guardrails also protect you from the opposite problem, overspending in a bull market. When your portfolio is up 30%, it is tempting to upgrade your lifestyle. But if you lock in a higher spending base, a single bad year can break you. The cap on raises prevents you from ratcheting up your spending too fast, so you enjoy the gains without risking the future. It is the behavioral equivalent of not eating all your chocolate on Halloween night. So Vanguard gives you 3 strategies: the smart withdrawal order, the essential expense guarantee through annuities, and dynamic spending with guardrails. But here is the uncomfortable truth they hint at, and I want to end on. The real reason I read this report for you? Not because annuities are good or bad, but because Vanguard's own research confirms what a handful of data-obsessed nerds have been saying for years. The retirement industry has been selling you a simplified version of math. They gave you a single number, 4%. Withdraw that, and you are safe. It was never a guarantee. It was a starting point. And now, with lifespans stretching into the 90s and early 100s, with markets that drop 20% every 6 years on average, you need something more adaptive. The uncomfortable truth is that most financial mistakes aren't math problems, they are brain problems. You see your portfolio drop by $100,000 in a month, and your instinct is to panic, to sell, to preserve what is left. That instinct has cost retirees more than any market crash ever did. The 4% rule was supposed to prevent that by giving you a number to withdraw no matter what, but it did not give you the structure to handle the fear. So you overspend in good years and underspend in bad ones, and you end up with less than you could have had. Retirement isn't about hitting a number. It is about building an income structure that lets you spend without fear. The 4% rule was never the golden answer. It was a starting point. And the people who treat it as gospel are the ones who end up either dying with $1 million in the bank because they were too scared to spend, or running out of money because they did not adjust when the market hit them. Lazy investing built more fortune than crypto memes. That sounds like a throwaway line, but I mean it. The people who set up a diversified portfolio, set guardrails, and then stopped tinkering, they outperformed the active traders, the timing experts, the people who thought they could beat the market. Because the market does not reward activity. It rewards patience and structure. So read the report yourself if you want. I will link it in the description. Or trust the numbers and build a system that works even when the market does not. That is the only way to stop the fear from making you poorer than you need to be. System that works even when the market does not. That is the only way to stop the fear from making you poorer than you need to be.